Hey everyone! A couple weeks ago, I shot a video refuting the headlines about how commercial real estate distress could create systemic banking risk. That's not to say that there isn't or won't be any commercial real estate distress. It's just not likely to cause severe banking fallout. Somewhere between $900 billion and $1.4 trillion of commercial real estate debt will mature over the next 2 years. And as I've mentioned previously, two segments of the commercial real estate market likely do face outsized risk. The first segment includes properties that were purchased using particularly aggressive underwriting and financing strategies. For example, an investor just handed the keys of a very large apartment property in Texas back to the lender. Behind that headline is a story that includes 80% leverage and probably a few other higher risk decisions. On average, most commercial real estate only has a 65% loan to value, so an investor using 80% leverage is taking more risk. Another higher risk option includes the use of floating rate debt without some type of rate cap or hedge. That's not to say floating debt doesn't make sense sometimes, but it is inherently more risky than fixed rate debt. Before the Fed started raising rates, investors could get adjustable rate mortgages in the mid 3% range. But those rates have now increased to 5%, 6%, even 7%, and in some cases, the 8% range. And higher interest rates have weighed on property cash flow, sometimes even running them negative. But these kinds of deals aren't the norm. They're generally the exception. And these deals won't create systemic banking risk because banks generally have more stringent lending policies in place and wouldn't provide loans on such aggressive deals. That said, there is a segment of commercial real estate with elevated distress risks and the potential to create ripples that impact other types of commercial real estate. That's office properties, particularly offices in the urban core. This risk is tied less to the investors and their strategies and more to changing behavior in the post-pandemic era. As everyone is well aware, workplace norms have changed. Before the pandemic, most white-collar employees worked at the office. Today, hybrid work models have become the standard in the American workplace, and that has dramatically changed office space needs. According to a data source that tracks keycard swipes in office buildings, most of the cities they report on have less than 50% office utilization. That could be half the employees coming to the office every day, or more likely, most of the employees going into the office 2 or 3 days a week. Of the markets tracked, Austin, Texas has the highest utilization rate, about 63%. At the other end of the spectrum, the Bay Area has a utilization rate in the 40% range. This implies that there's a significant office space overhang, and many companies may shrink their footprint when their leases come due. That could boost office vacancy rates in some markets to the 25%, 30%, or even the 40% range. And that could spark a wave of distress that lenders would have to contend with. Office properties represent about 26% of the loans scheduled to mature this year. And a significant rise of urban office vacancies could create ripples that carry into other property types in the urban core. The concentration of the office workers in the urban center creates a local urban ecosystem that fuels other businesses and industries such as retail, tourism, restaurants, and entertainment, which in turn makes those areas appealing to live in. So a sharp rise in urban office vacancy could weaken other properties in the urban core, creating a snowball effect. If that were to play out, and we are starting to see some cities with those types of problems begin to emerge, then the potential risk to the banking system rises. But whether that plays out will depend on a variety of behavioral, societal, demographic, and public policy issues. So yes, there is some commercial real estate distress out there and some real risks. But at this point, a massive wave of distress remains unlikely. That said, we will be navigating some choppy waters over the next couple years, so investors will need to remain vigilant and keep their eyes on the horizon.